Okay, good morning, everybody. Thank you very much for joining us today. This is a virtual session on estate taxes with our very good friend Michelle Coleman from MNP. My name is Matt Mandrusiak. I am the Manager of Philanthropy here with Edmonton Community Foundation, and I want to thank all of you for participating not only in this session, but in any of the other Wills Week sessions, both virtually and in person that we've held so far this week. Um, it's thanks to an amazing group of of lawyers who and tax professionals who have volunteered their time to help us put on 14 different Wills Week presentations, both online and in person, throughout this week to help guide you in the proper preparation of your estate plans. These plans include not only a will to protect your family, your business, and your assets, but also two additional documents that help you during your lifetime should you temporarily or or permanently lose your independence. Understanding the hardships and additional costs that occur when these estate documents are not in place correctly will help you to appreciate the value of getting professional help for you and your loved ones. Edmonton Community Foundation is pleased to provide Wills Week as an important resource for Alberta-based will and estate information. It unites our role as a trusted partner to help people create a legacy for their community. Our area of expertise is endowment funds, contributions that are invested to provide ongoing support to enhance our community during and after our lifetimes. To learn how these funds are affordable options and how they can help save you taxes, please visit our website, ecf.ca. In our work, we see a lot of wills and understand how powerful these documents can be. We want everyone to benefit from these Wills Week sessions and understand how professionals can make you and your will more effective and more accurate. If you have any questions during Michelle's presentation today, please type them into the Q&A box. To find that box, go to the bottom of your screen. We will try and answer as many of these questions that remain relevant for the group as a whole as possible towards the end of Michelle's presentation, so do feel free to send in questions throughout the discussion. To protect your privacy and in the interest of time, we will not be able to answer any case-specific or information-specific questions. I also need to advise you that this presentation will be recorded and will be made available on our website, ecf.ca, within the next week or so, once we wrap up Wills Week. And finally, before I introduce Michelle, just one more note or housekeeping note. At the end of this webinar, we ask that you please take a minute to fill out the survey that will pop up on your screen. This will help us make sure that the feedback we're getting from the public lets us know if we're putting on something that's worthwhile. We really want to make these sessions informative and something that people will keep tuning into or coming to in person. So your couple of minutes to fill out those surveys really does help us make sure we're putting on something that's worthwhile to the public. And now that my preamble is done, I will introduce our presenter for this morning, Michelle Coleman. Michelle is a member of MNP's tax team in Edmonton who specializes in trust and estate planning. She works with individuals and business owners on everything from retirement, estate, and succession planning to corporate reorganizations and CRA audits. Michelle is a chartered professional accountant with advanced tax training and holds both the Trust and Estate Practitioner (TEP) designation and the Certified Executor Advisor (CEA) designation. She's passionate about sharing her expertise, mentoring CPA and STEP students, serving on national boards of both STEP and CEA. And in 2023, she was recognized with CPA Alberta's Early Achievement Award. And so, Michelle, I am going to turn it over to you, turn off my camera, mute my microphone, and let you take it away. Thank you very much for being here.
Wonderful, thank you. Just this worked when we did the experiment, so hopefully it will work now. Perfect. Okay, so unless I hear otherwise, I'm going to assume that we're sharing all right. Thank you very much for the invitation to be with you today. And the the impact will be me trying to stay to the time frame that we have because I love talking about these topics and love sharing that information. And so hopefully we'll get some information in your hands that is going to help you first plan now, or if you are going to be an executor or are an executor now, some things you'll be able to use as well. If you've watched these presentations before, you will see some overlap because although from a tax perspective, there's been a number of changes in the last 10 years, a lot of things are very much staying the same with respect to how you're going to plan for your future estate and also how you're going to deal with those plannings as an executor of an estate. So we're going to look at a few things. We're going to look at the tax filings that need to be done, some of the tax impacts, some planning tools, how we can maybe reduce tax, which is quite often a goal when we're doing our overall planning. Some things we need to think about with residency as the world gets smaller and people are scattered a little further away. And then information you're going to want to make sure you've got gathered up in files for either your executor or start to look for if you are an executor. And then clearance certificate, as that quite often comes up as a question of what do I need? And so, as I mentioned, you'll see some things that are very similar, but hopefully the questions we have will make this one a session that's very useful for you specifically. The most important thing to do overall when we're looking at planning an estate, taking part of being an executor for someone's estate, is building that support team. And that support team is going to be, of course, made up of family and friends who are able to give you some advice and perhaps taking on that role. Government agencies and community organizations have a huge amount of resources available, such as the Community Foundation site providing information. Financial advisors are going to be able to give you advice on where to access funds first and provide reports for your other advisors to work with you also. Legal counsel, of course, to put together, excuse me, your will, power of attorney, and health directive. And then, of course, my group, little bias here on being favorite accountants, tax specialists, and estate planning advisors. But what is working best is if all of those people are working together in a team so that we're all rowing the canoe in the same direction and not implementing plans on one side or the other that are interfering with the plans that the other has set up. And when we think of estate planning, it's not just signing a will. It's the big document we think of. But if you own a business or rental properties or self-employed, some different ways we have to look at potentially your business structure and whether or not it makes sense the way that it is. What income splitting opportunities do we have? Those have certainly been lessened with some of the tax changes that have occurred in the last several years. And of course, asset protection. We're going to talk a lot about doing planning from a tax perspective, but it is very important to take a step back and say that we don't want to necessarily plan just for tax because there are other things that are going to be equally, if not more important. So that could be protecting individuals in your will through setting up various structures to perhaps make sure that they're not going to be influenced or lose benefits they have. Asset protection also very important. So making sure we're looking at those things together. Legal planning, of course, putting the trusts, wills, power of attorney, and personal directive in place. Risk planning. So what do we have that we do want to think about? And part of that is that asset protection. Risk planning could include life insurance, where we're using that to either create an estate, preserve an estate by being available to pay taxes, or to equalize an estate if perhaps farming is a good example, where we have perhaps a child who is active in the farm who will be receiving the farm property, which is quite expensive comparatively speaking to some other assets you may have. And then some of those assets, that insurance would be available to equalize what you're giving to other beneficiaries. And then, of course, tax planning, trusts, restructuring, gifts during your lifetime or in your will, and then, of course, donations. When you're looking at updating your will and making sure all of your documents are together, when we meet with clients to see what other impacts we could have with respect to what tax planning we can do, we also ask about prenuptial agreements, divorce settlements, and adult interdependent relationship agreements. Are those perhaps impacting what we're able to do or not do from a planning perspective? And that's both talking to your lawyer and making sure they're aware of all of those things, but your tax advisor, again, making sure that we're not assuming that something is available or not available for tax planning that may or may not be. Beneficiary designations and shareholders agreements also will impact what we're perhaps able to do from a tax planning perspective. So if we look first at tax filings and what are we going to have to do, because where is that tax number coming from? When you if you were an executor for someone, you would be coming in and looking at what tasks do you need to do. And so the first thing is going to be getting access to CRA accounts individually or together with your tax advisor, and determine whether or not there's anything missing from before. So perhaps someone who has been ill leading up to their passing, perhaps they haven't filed tax returns for the last couple of years. To make sure those prior years are caught up. We also need to look to see if there's anything that may have been missed on prior personal tax returns. So perhaps the individual had been doing their returns themselves and they weren't aware of a foreign asset reporting requirement or something like that that we need to pick up and make the corrections to. We also have to look at outstanding filing requirements that are under any new or amended legislation, and that would be federal or provincial, primarily federal, where we're looking to see are there things that are set up within the will that are going to actually have an earlier filing deadline? And we'll talk about those in a little bit further. If you have individuals who are sole proprietors, so for example, someone who's running a business under their individual name or farmers, for example, we want to make sure GST returns are done and kept up to date. And any GST that needed to be remitted is also remitted on time. Similarly, if you have an individual who had employees, their payroll accounts are going to need to be kept constant and consistent, and any remittances done on time. Because the GST and the payroll accounts are trust accounts in that CRA considers, rightly so, that that's not actually the individual's money, we definitely have to make sure we're updating those as we go. And then if there are any outstanding CRA requests, and so perhaps medical expenses or donations or something have been requested for support, make sure that those are responded to. So it's easier to respond to those requests in as timely a basis as you can versus having to go back and appeal or amend returns. And the reason why it's very important that you make sure that your executor is in a position to be able to file these, or if you are an executor, you make sure you do file these, is that there are some potential areas for liability. So under Section 160 of the Income Tax Act, CRA can assess for other persons' tax liabilities if the deceased individual received transfers of property for less than fair market value consideration. The reason why I've noted that one in there is sometimes people sort of look and go, well, I could just start gifting things now and giving things away or selling things at a discount to individuals so they're not part of my estate. They're not going to be part of probate. They're not going to be part of this deemed disposition that Michelle's going to talk about in a minute. But keep in mind that you can't really hide where the tax is going to happen. And if it doesn't end up in the estate, it will still end up somewhere. So make sure you talk to your advisors if you're looking at doing some of those gifts during your lifetime or had anticipated doing some sales for perhaps less than fair market value. Director's liability for unremitted source deductions, which we just mentioned earlier. So making sure those are up to date. And also people don't often consider that we may have a US gift or estate filing tax on US situs property gifted either during the lifetime or was still owned at the date of death. And so we often think of those US properties as thinking, well, I don't have a vacation property, but that may pick up some other assets as well, which we'll talk about in a bit more detail in a bit. So the first tax return, assuming everything else is caught up and done and we don't have anything to do from prior years, the first return that's going to be filed for the estate is going to be the T1 personal income tax return. And it's referred to as either the terminal or final return. That will be the last return that's filed under the individual social insurance number, unless we have a possibility of filing an optional return which is really beyond the scope of what we're getting into today. But in general, this was going to be the last return that we'll file for an individual. It's going to cover the date from January 1st up to the date of death. And if death occurs prior to November 1st, that tax return is going to be due on or before April 30th of the following year, June 15th if they were self-employed. And if someone passes away late in the year, so November 1st to December 31st, that return is due within 6 months of the date of death, so a little bit longer to allow to gather up information. Truthfully, from a practical perspective, if records are accessible to you, slips and things are going to be coming quite early in the year in spring like they would normally. So there is a possibility you could still file for that April 30th deadline and sort of be moving ahead, but you do have a little more time to gather that information and a little more time to pay that tax. And the payment of the tax being deferred just a little bit longer is potentially even more important than that filing deadline, because maybe you need to liquidate assets and have things available for the payment of tax. I'll take one step, although I've advanced the slide. Sometimes people will say, I don't want to file until I have all of the information. It's actually very important to still file on time and then amend later if we need to, because the late filing penalty for tax returns is 5% of the taxes owing. And so we want to make sure that we don't have a late filing penalty. We may end up with interest if we have additional income to report later, but we're reducing the impact of that larger late filing penalty. So we just sort of flip ahead now of what things are going to be on that personal income tax return, that final return. So it's going to be income and deductions from January 1st, the date of death. So we're looking at perhaps employment income for that period, investment income for that time, whatever would normally be reported on a tax return. So in many ways, it's a regular return for a shorter year. We're also going to pick up any capital gains or losses that occur from January 1st to the date of death. So things that you've sold, perhaps real estate, perhaps investments in your investment portfolio, sort of looking at what happened before the individual passed away. RRSP and RIF balances, assuming that we're not transferring to a surviving spouse, we need to know those fair market values at the date of death. And those are going to be treated as though they're withdrawn all at once and included as an income inclusion. If we have a surviving spouse, we have some planning options, which we'll discuss in a few minutes. Disposition of the principal residence as well. Up to 24 months of medical receipts. So of course, those that we haven't claimed before, but sometimes people don't have quite enough in 1 year. So in the year that someone passes away, we can go back a little bit longer. Other income deductions, credits as applicable. So other income that you would pick up from various sources, royalties, perhaps, other things like that, your deductions for accounting fees or similar items, and then credits, of course, for medical donations, employment, and so on that you would normally get. Those credits aren't prorated for the year. It is a full credit, the same as it had been a full taxation year. And then we have the deemed disposition of assets that were owned at the date of death. And we'll talk about that in a little more detail. When we're looking, just flipping ahead to what return comes next, sometimes people sort of set things aside and think, well, I don't have to file anything until I've actually settled the estate. They've gotten that information from someone. Unfortunately, they do need to file consistently throughout the period that you're administering an estate. So on the day after someone passes away, their estate begins. And their estate is going to cover a period. In the first year, it's going to cover a period from the day after the date of death to a maximum of the anniversary of the date of death. And so that will be the first year of the graduated rate estate. And that graduated rate estate will have its own tax number because it's a different person for tax purposes. If you were wound up a little bit earlier, or if it made sense to pick an earlier date, we can pick any date in between those two sort of ending points that I mentioned earlier. Tax returns are going to have to be filed within 90 days of the selected year end. In every year that we have activity still occurring in the estate itself, we will continue to file a tax return each year up to the wind up of the estate. We're also going to have to make sure that we file T3 returns for trusts set up in the will. If you have an estate that you've been looking after that extends beyond what is typically the 36-month period, 36 months is the period of time that I'll just say we're allowed to be a graduated rate estate and have some tax planning advantages. Once that 36 months has passed, it will become, we'll call it a regular estate, for lack of a better way to put it. It will no longer have access to graduated tax rates, will no longer have access to some other tax planning opportunities, and will move to a December 31st year end. And so work together with your advisors on when things are due, because again, that filing penalty can be significant, and making sure that things are occurring within 90 days of the year ends with respect to these estates and trusts. And so we mentioned the penalty already. I just want to mention as well that if you're going through the various records for someone and realize that they perhaps have not filed some previous personal income tax returns, unfortunately, you're going to be sort of caught where you're, we'll just say, tarred by the same brush, and the individual returns are still considered to be late. And so if an individual has had multiple years where they have a late filing penalty, that penalty can increase to 10%. So it's going to be particularly important to gather information as an executor and file this terminal tax return on time, because it can be significant, the amount of tax that is on this return, depending on what's happening, what they owned, and whether or not there's a surviving spouse. T3 tax returns, same penalty. Even if there's no taxes owing, there may be a late filing penalty based on $25 a day to a maximum of $2,500, which will increase if you start to get demands to file. So make sure you open all that CRA mail. Make sure that you're responding to that on a regular basis and a timely basis. I've got a note here off to the side on this slide with respect to trusts in wills. And so when you have your estate, that's going to be dealing with most of the assets that the individual has that didn't pass outside for other reasons. But if, for example, you have a trust that's set up for grandchildren for education, or a spousal trust set up for the surviving spouse, or a trust set up for a disabled individual, those trusts are going to have each one have their own separate filing requirement. Their year end is going to be December 31st. And so the trusts in the estate might actually the trust within the will may actually have a filing deadline that's due earlier than the terminal tax return or the estate tax return. So we do want to make sure you reach out to advisors early and get an idea of what needs to be filed when, whether or not we can apply for any exemptions, or are looking at that filing requirement right away for trusts that are set up within the will itself. The penalty for failure to file on those trusts in the will can be the greater of $2,500 and 5% of the highest amount within the trust in the year. And so that obviously can be quite significant, and is grinding down the value of that trust. And it's not really doing what the individual had anticipated it would do, paying for education and so on. Other filings that may need to be considered would be the underused housing tax. And when we're looking at the underused housing tax, we need to look at the residency or citizenship of the deceased individual, also of the executor and beneficiaries. And then I've got a note here of reviewing the current filing requirements. So if you've had to file the underused housing tax return for yourself, or know of people who do, the first year that that underused housing tax came out in 2022, its scope was much broader. And so there was more of a filing requirement in 2022. And then as the legislation got refined, that did change a bit for 2023 and years going forward, and may change again in the future. So just being aware of sort of where the individual who passed away was a citizen of, or is not a citizen of Canada, or is not a permanent resident, perhaps we have that underused housing tax filing requirement, and making sure we don't miss it. T4 statement of remuneration paid, so executor fees. So it is executor fees are taxable income to the individual receiving the fees. So we need to make sure we file a T4 slip from the estate. That's quite often missed or is late, because perhaps we'll get the accounting and say, well, where did this money go? And it was the executor fees. So we need to make sure that those are reported on time. Non-resident reporting requirements. So that's going to depend on what assets were owned and the residency of the beneficiaries and the estate itself. And then we mentioned already the T3 and income tax and information returns. And so that's the estate returns and returns for testamentary trusts. So testamentary trusts are trusts set up in the will, whereas inter vivos or trusts are those set up during your lifetime. Now, tax impacts, and where is that tax number coming from? So I had mentioned earlier that that tax bill on that final personal tax return can be quite significant. And for a lot of people, it might actually be the highest tax return. If they haven't sold a business or sold a farm or those kinds of things, we perhaps have that highest tax bill on this return. So that's coming from a couple of different areas. And so these slides are assuming we don't have a surviving spouse to pass things along to. The disposition will occur regardless, but we have some planning opportunities with spouse versus other family members or other individuals. When an individual passes away in Canada, they're deemed to have disposed of all of the property that they own, including real estate, shares of private corporations, investment portfolios, your personal items as well, and listed personal property, which would include things like jewelry, book collections, art collections, sort of things that you purchase with an intention that they would go up in value. That disposition occurs at fair market value, and a tax is going to be paid on the increase between what someone paid for an asset and what it was worth on the day that they passed away. And so that's going to be a capital gain that's reported on that terminal tax return. If we have a surviving spouse or a common law partner, those assets can be transferred at cost and deemed to have been disposed of at cost, deferring the tax until the surviving spouse either sells the assets or in their future estate. That's also going to include the deceased share of jointly owned property with a right of survivorship. And so sometimes people are thinking when they're, especially with their executor, or they're thinking of their future planning, I'm just going to add someone to title of real estate, for example, and it's just going to pass outside of my estate and it will be fine. It will pass outside of your estate to the individual unless there's documents that specifically say it was for estate planning purposes only. And was not a gift at that time. But assuming that it was a gift at that time, that doesn't help with the tax. We still have that deemed disposition of their share of the property and taxes arising in the estate for the disposition of their share. So if someone owns 1/5 of a lake property, for example, together with their siblings, it's perhaps going to their surviving siblings. It will go to the siblings, but the tax bill is remaining within inside the estate. And so we need to make sure that we're planning for liquidity in your estate to pay for things that are also passing outside. If certain criteria are met, capital gains from the deemed disposition of some assets can be offset with a capital gains exemption. And so that would be items like privately owned corporations and qualified farm or fishing property. And so that lifetime capital gains exemption is about 1.25 million now. And so that can offset some of that tax. So we want to make sure we have good records of what's been used in the past. We just want to just put together sort of a flow chart to sort of say where some of these things are going. Because I think as well, when you're meeting with your tax advisor for the first time, you've come with that list of assets that are still part of the estate and the items that you as an executor are dealing with. And, or again, you're sort of thinking ahead to your own estate. So items that are passing outside of the estate for non-tax purposes would be items owned jointly with a right of survivorship, items with specific beneficiary designations, and life insurance with specific beneficiary designations as well. Now, life insurance, we wouldn't typically see a tax impact for life insurance. There's perhaps a little bit on an investment component, but a death benefit paid out from a life insurance policy is not going to be taxable income for the estate or the individual who's receiving it. The items with specific beneficiary designations or that portion of jointly owned property is going to be taxed within the estate, not in the hands of the individual who's receiving it. So when you're doing your planning of what you're splitting up, you also need to consider the tax impacts of what's going to individuals as well. And the items we see most often For jointly owned property would be joint bank and investment accounts, for example, or real estate and other similar property. Excuse me. The one item that people often are thinking about as perhaps one of their biggest assets is their principal residence, so the home that they live in. At the date of death, there is also a deemed disposition of the principal residence that's owned by the deceased individual. But if certain criteria are met, that capital gain arising from that deemed disposition can be offset by the principal residence exemption. Now, since 2016, there's been a requirement to actually designate a property as your principal residence if you did sell a property. So if individuals have owned more than one property that have overlapped, they've perhaps used their principal residence exemption in some years when they sold the first property or gifted the first property. So it's important to know the history of real estate that's currently owned, plus the history of real estate that have been previously owned to look at any overlap. And so because in each year, only one property can be a principal residence. We don't need to make the designation until a disposition actually occurs. So when you're doing planning for yourself and sort of tucking aside in your head, what do I need to think about with a vacation property and a personal home here in Edmonton, perhaps? Talk to your tax advisor when you're thinking of gifting or selling property and determine what property it makes sense to make the designation on in the years owned, and have good records of that in your files so that the tax advisor knows what's available in the terminal and estate returns in the future. Registered retirement savings plans, so RRSPs, or registered retirement income funds, RIFs. The general rule as at the death of the annuitant, it's considered the annuitant, so the deceased individual, received that fair market value of all that property held at the date of death. And that's a full income inclusion. And so that one can be quite shocking. And so work together with your financial advisor leading up to your future estate of where money perhaps should be accessed during your lifetime, to sort of look at what tax brackets are being used to perhaps avoid all of this being taxed at the highest tax bracket on your passing. And so it's a bit of a balance of determining what you're going to take out from those registered accounts during retirement versus where you're going to access it from other places, and retaining your old age security benefits as well. And so there's always going to be a bit of give and take on those, but it's important to have those discussions and be aware of what's going to happen and when things are going to be taxed. There was an article, I think it was CTV, about 2 weeks ago, with the headline that individuals were quite shocked that they had to pay $660,000 of taxes on their parents' estate. In that instance, both parents had passed away in the same year. So although we initially had a tax deferral on the death of the first spouse, on the death of the second spouse, there was a large RIF that came into being taxable in that year, and all being taxed at the highest bracket. There were a number of other things that were going on in that estate as well. But really what came from that article, if you do review it, is that's why it's important to have these conversations. Having these conversations with your advisors, with your family, with your partner, to determine what makes sense. Because we might be able to decrease tax a bit, depending on where things are, or defer tax, but ultimately there is going to be a tax bill, and where do we want that tax bill to be? There are some exceptions for that RRSP or RIF income inclusion. So if there's a spouse or common law partner as the beneficiary of the plan, and the plan is transferred into their plan, then that tax on that income is deferred until that individual withdraws the money over time or in their future estate. It can transfer to a qualified beneficiary, and that is typically going to be an adult or minor child, depending on your situation. A qualified beneficiary is generally going to be an individual who's dependent upon you because of a disability. And so talk to your advisors about whether or not that's an option, or a transfer to an individual for a registered disability savings plan. So again, deferring that tax. In some instances, you're going to be limited to transferring into an annuity that's withdrawn over a set period of time. But again, knowing what that planning is going to make a big difference in what you want to do and what decisions you want to make now and for your future. Tax-free savings account was able to grow on a tax-free basis up till the date of death. If your spouse is named as a successor holder, that can be transferred to their tax-free savings account without them needing additional contribution room. They just kind of double up on their space. You don't double up going forward though. So the surviving spouse is going to continue to just create one person's contribution room in each year. So currently about $7,000 a year of space. You can have other designated beneficiaries. They will receive the amount that was able to grow on a tax-free basis up to the date of death, but may end up paying tax on a little bit of increase in value, or hopefully a lot, depending on how the markets are, between the date of death and the date that they actually received the amount. And so there might be a tax slip that will come to that individual. If the estate is the beneficiary of the tax-free savings account, the estate would pay tax on just that difference between the value on the day the individual passed away and the value the day that it was liquidated. Residency is important for overall trusts and your estate as well. And so the residency of an estate or a trust is going, and an estate is just a fancy kind of trust. The residency is going to be based on what they refer to as mind and management. And so what that means is, where are decisions made? And where are things ultimately being decided, allocations of income, what things are invested in, when things are going to be sold, etc. And so that is typically going to be where the executor lives. And so that could be perhaps the province of Alberta. You usually are going to try to pick someone who lives close to where your stuff is in order to be able to deal with it. It might be another province in Canada, because perhaps the individual that you trust most to take on this role has moved to another province, or perhaps you've moved here and they're not going to be in the same place. And so your estate, you may be here in Alberta and file your final personal tax, the final personal tax return be filed as Alberta resident. Perhaps your executor is in Ontario, for example, and your estate is going to be resident in Ontario for tax purposes. Within Canada, we're going to have a bit of variation on tax brackets in different provinces, but overall is going to be relatively equivalent. Maybe we've got some provinces that are a little higher than others, but your key concern is going to be who's the right person to manage this versus what's the total tax rate. If the individual is outside of Canada, though, that is going to be a significant issue. So if perhaps the person you have named as executor is living in the United States, then the estate is going to become a US estate and have a number of different filing requirements. So it is going to be important to try to have the individuals who are either your power of attorney or your executors or trustees in the future are resident of Canada. Residency of the executor we've just discussed. It's going to be important to keep track of the residency of the beneficiaries as well, because there's extra filing requirements to show that an individual who's not within Canada is receiving assets from an estate. Depending on what country they're in, there's not going to be any tax impact for the beneficiaries themselves. But as the executor, you're going to have a requirement to make sure that in some cases report in advance of the distribution, and in other cases report just after the distribution. So talk to your advisors early about what reporting is going to need to be done, because that reporting that needs to occur in advance does need to be very timely with respect to when that distribution is going to occur. And the notification that the distribution has occurred is due within 90 days of the year end of the estate or the calendar year, depending on where you're sitting in the administration of the estate. Your beneficiaries should be talking to their tax advisors in the country in which they live, because there are some countries where there is going to be a tax on the receipt of an inheritance. And ultimately, that's sort of going to work out. That is going to be their responsibility, but it is something, if you're doing your planning now, you may want to contemplate on whether or not you need to consider that or want to consider that in equalizing things that are going to various people. And then just noting there's those additional filing requirements. Trust reporting is also going to be something we're going to have to be cautious of going forward. Now, we do have notification of a new budget on November 4th, and we've got some notes for what they're proposing for draft legislation. Legislation that we had drafted previously that was anticipated to go through before the change in government. When that change in government occurred, that legislation, say, died, as it were, and will need to be reintroduced. And so we're going to need to look at what new reporting rules for trusts are coming into play. But for now, we have new reporting rules for trusts for the period ending after December 30th, 2023. And December 30th is a year that's picked because that picks, or a day that's picked, because that picks up any year end for December 31st onwards. The new reporting requirements, we talked earlier about perhaps there being a filing requirement, even if the trust sort of doesn't feel like it exists because nothing's been put into it yet, a testamentary trust in the will, and you're still working through the estate, may still have an additional filing requirement with a new form called Schedule 15 that's reporting the details of the individuals who are involved in the trust. So talk to your advisors early about whether or not we need to make sure we gather that information. That information is a lot easier to gather up as you're doing the entire estate administration because nobody's really curious about why you're asking at that point in time versus trying to gather it up after you've done some distributions. Some other situations that might be caught for filing requirements during your lifetime is names added to title for estate planning purposes. So sometimes parents adding children to title. The upcoming draft legislation may have some exemptions for that, but we just still don't have it as actual legislation yet. So sort of go on that worst case scenario and see where things sort of come back to. Also picks up names that are added to bank accounts for ease of management of day-to-day affairs or estate planning purposes. And there are a number of exemptions, and we're anticipating there are going to be even more. As the sheer volume of trusts that are being filed, I think was a surprise to everyone. Trust and wills we've discussed already, and the penalties as well. So that big question then of how can we reduce or defer taxes in an estate? So we want to make sure that we meet with an experienced tax professional as soon as possible. Some planning has to occur in the first taxation year of the estate. So that year that we were talking about from the day after someone passed away to the anniversary of their passing. But taking a step backwards of planning for your own estate, meeting with advisors now to work together to look at your will from a tax perspective, in addition to a legal perspective, talking with your financial advisors together with your tax advisors about where to access income during your lifetime, looking at what gifts you can do during your lifetime or may want to do. We can consider the use of spousal rollover. So that's that deferral of tax that I was mentioning earlier. If it's going to a surviving spouse or common law partner, or even during your lifetime, you can look at gifting to a spouse or a common law partner, being cautious about whether or not income is going to attribute back to the individual giving the gift. We can transfer to qualified beneficiaries, certain trusts called qualified disability trusts, and we have some options for elections. We want to make sure that we don't miss things or leave them on the table, such as losses and deductions. We're going to want to confirm the availability of the capital gains exemption. So using those on qualified small business corporation shares or farm property. Make sure we pick up the principal residence exemption, and we're taking advantage of all of those exemptions that are available to the individual, either as gifts during your lifetime or in your estate itself. And we also want to manage trusts set up within the will and an estate in such a manner that the graduated rate estate status is not lost. So I was mentioning in that first 36 months, an estate is a special kind of estate, even called a graduated rate estate. And overall, managing it in such a way that it's keeping that status is really keeping it independent. And so not loaning it money, and making sure that if you pay for some expenses that you're reimbursed right away. But again, talking to people early to make sure that you don't, what they refer to as taint that graduated rate estate status and not have access to those better tax brackets and planning opportunities. Make sure you gather that history. So pick up previous personal tax returns, review Canada Revenue Agency history, make sure that we haven't left any losses behind. There aren't donation receipts that haven't been picked up. That 2 years of medical receipts, make sure we're picking those up as well. Donations, however, can be one of the most powerful ways that we can reduce tax, both during your lifetime in any taxation year or in your estate itself. So we can look at donating in several ways. We could donate the life insurance policy or your registered accounts, such as the RSP, RIF, TFSA. The donation of life insurance policy, the tax benefits for those and when you'll get a donation receipt is going to be dependent on whether it's a new policy or a current policy and what you're sort of doing with that. So if you have a policy you're looking at canceling, but thinking, well, maybe there's something I can do with it, talk to your advisors. You can also donate assets, so land, art, jewelry collections, etc. But one of the most effective ways to reduce your tax is to look at the donation of securities or mutual funds. And again, that's working for current or estate planning. And so when we're looking at the direct donation of securities, if we use an example where we are first going to sell those securities and donate after cash proceeds. So if we had originally paid $10,000 for the securities that are sitting in your investment portfolio, and they're currently worth $50,000. Capital gain, of course, is going to be $40,000 on that, 50,000 minus 10,000. Capital gains inclusion rate, I had a little asterisk next to that, and I forgot to remove it because we had that fuss last year about whether or not we were going to have changes in the capital gains inclusion rate, but going with a 50% inclusion rate. And just for illustration purposes, let's just use the highest personal tax rate. Your tax rate is going to be dependent on what other income you have and where that's ending up. Taxes on capital gains in that example is going to be $9,600. So you have just over $40,000 available to make that donation if we wanted to stick to that $50,000 amount. And you'll get a donation tax credit for just over $20,000. And so that's good, but we can do even better. And so if instead you donate the securities directly, so we have, again, those same values, but our capital gain inclusion rate is 0. And because that capital gains inclusion rate is 0, we're not paying tax on the capital gain. And so by not having tax on the capital gain, we have a full value of that $50,000 available to donate to the charity of choice. And we get a donation credit just shy of $25,000, so approximately 50 cents on the dollar. And most charities, including the Community Foundation and other charities throughout the city or organizations, are able to accept those securities. And if you are working with an organization that perhaps can't take securities directly, then there are other organizations that you can work through, such as perhaps setting up something through the Community Foundation or working through an organization like Canada Helps that will flow that funds through. And so that donation of securities is a very valuable planning tool in your annual giving and also in your estate. Donations made within your will itself are very effective for planning for your estate. When I talk to people, I say, well, we've got your beneficiaries, but the government's a beneficiary as well. And by doing donations in your will, we can decrease the size that the government beneficiary is receiving faster than we're decreasing what's going to the other beneficiaries. Obviously, if assets are going outside of your estate to charity, you are decreasing the size of your estate, but you're receiving a significant tax credit, which is sort of offsetting the tax that is paid, and we sort of continue to balance that out. Donations that are made in your will can either be used on the terminal tax return, the year before the individual passed away, or in the estate returns. And so that can be done if your estate is a graduated rate estate. So important to keep that status, as we mentioned earlier. Your tax advisor is going to need a copy of your will, the full application and grant of probate, copy of the death certificate, even though it's potentially been sent to the CRA already, perhaps by the funeral home, it's going to need to be provided again. We just treat every department we're dealing with as someone who's going to need all of the information again. Copies of previously filed tax returns, about 3 years, is useful because not all income comes in each year. And so it gives us an idea of what might be missing. summaries from the investment brokers. So personal records if it's personally traded. We need to know the fair market value and cost base of all the investment accounts, including your registered accounts at the date of death. Reason why we're looking at all of the accounts, included the registered accounts, is we're also looking to see if there's more than $60,000 of investments directly in US corporations across those accounts in aggregate. So if there's a possibility we have a US estate filing requirement. It's unlikely you will end up paying tax, but there's potentially a filing requirement. So we need to make sure we check across all of those. Looking at adjusted cost basis and fair market values of personal assets and their history. So if you've got a book collection or jewelry collection or art collection, having good records of how much you paid for things and when you purchased them, because that's part of that deemed disposition in your future estate. History of ownership as well, what property overlaps with real estate, and income slips and receipts for the deductions or credits. We want to get an idea of what that tax liability is early, because perhaps it's higher than you're anticipating. It's perhaps much higher than it had been in previous years. So we want to make sure that the executor is aware of what that liability is likely going to be based on the information we have at a point in time, so that you can start to determine where cash is going to come from. Do things need to be sold or liquidated? Do we have life insurance available? What tax planning options do we have? The executive fees mentioned earlier, that's taxable income for the recipient. We just put in a slide specifically about it because it does end up being missed often. Sometimes executors will plan to take it over 2 years to not have as much impact on their own personal returns. And so bringing in 2 smaller amounts of income rather than 1 lump sum. It's not deductible on the estate return for tax purposes, so it can only be deducted under certain circumstances. So we do end up with a little bit of double tax and tax leakage on that because we're not deducting, but someone else is paying tax on it. But ultimately, being an executor is a lot of work. And so you do want to look at whether or not you do want to be paid for that, or have the individual that you select for your estate be able to take payment for that. Clearance certificate. The clearance certificate is the document from the CRA that confirms the estate of the deceased individual has paid all taxes, interest, and penalties for the estate and the deceased individual. And it does allow the legal representative, the executor, to distribute assets without risk of personal liability if CRA were to reassess a return in the future. So it is important that you do make sure as an executor, if you're ready to distribute assets, you have that clearance certificate in place to protect yourself from personal liability. I've got a little asterisk next to that because the clearance certificate doesn't actually cover GST or payroll. And so if you're working with someone who perhaps has had an employee or had a business that they were collecting GST, you want to make sure that you do have those tidied up really well and perhaps apply for a separate clearance certificate for those. And that was a lot of me talking at you really quickly. I think I stayed reasonably on time and have time for questions.
Sorry, just trying to get the camera back on there. Thank you, Michelle. Yeah, we do have some questions here, and we do have some time to address them. So we'll get into a couple of them. There's been some questions around capital gains and taxes around property. So I'll start right off the bat here. I have sole ownership of a rental property. What is the tax implication of giving them to my spouse in the will? Is there any capital gains that I'll need to worry about?
Okay. And so if you are leaving assets such as rental properties or other real estate to a surviving spouse or common law partner, on your passing, those can be deemed to have been disposed of at cost. And so they go to that surviving spouse, and that surviving spouse or common law partner is going to have the tax bill in their hands in the future when they either sell that property or in their future estate. Now, sometimes we deliberately trigger tax to use up losses and things, but in general, it's going to be at cost and the tax deferred till later.
Okay. Great. Yeah, quite a few questions coming in on residency and things like that. So maybe we'll
Okay.
stick with that topic here. Um, where did this go? Oh, here it is. If someone adds their children to the title of their home as joint tenants during their lifetime, will there be tax consequences in the year that they execute the transfer? Are the tax consequences upon death?
So sort of answer that in two ways because tax, like in a number of instances, the answer is it depends. And not meaning to be flippant, but if we look at a couple of scenarios, and so if you add a child to title, I I'll back up one step. In Alberta, we don't necessarily do a lot of planning for probate purposes because in Alberta, probate is a set fee that's less than $700, and we don't do a lot of planning around that. But if, for example, you have a vacation property or home in British Columbia, which has much higher probate fees, we're looking at options from a planning perspective, both legal and tax, and working together with lawyers to implement that, of how can we reduce probate fees in addition to what can we do for tax purposes for federal and provincial tax. And so sometimes people who are doing probate planning will also add their children or a child to title, not intending it for it to be a gift now, and clearly define that it's not meant to be a gift now. The person is being added to title for probate purposes or estate planning purposes only. To make sure we have something in writing that specifies that that was the intention in order for there to not be a gift then. So if you add someone to title now, clearly define it's only for those purposes and it's not truly a gift at this point in time, there wouldn't be a capital gain tax on the disposition of it in the year that it occurred, and it will happen in the year of death in that deemed disposition. If you truly intend there to be a gift now, then yes, you have disposed of it for fair market value, and there will be tax arising at that point. We also have to make sure that you watch what the tax filing requirements are for trusts and what exemptions we see coming forward, because right now that potentially also creates a trust filing requirement each year because your child is kind of holding a share in trust of the property. So make sure you ask the questions before you do it.
Okay, great, thank you. One more around principal residency. If principal residence is left to a trust, with the second wife having use of the trust for life and then transfers to a child from the first marriage, would the time in the trust be subject to capital gains, or can the exemption still be used?
Okay, and so that's a good question because part of the changes to some of the trust filing requirements that occurred, well, actually 10 years ago, but still sort of seeing the results of some of those things, is there was a limitation on what kinds of trusts and properties in trusts were going to be able to use the principal residence exemption, because that was considered to be an individual's exemption. And so what you're referring to is a spousal trust being set up within the will. And so a spousal trust is a trust that's going to hold property that only the surviving spouse or common law partner has access to the income and capital of during their lifetime. So that can include moving a house in. And that is a specific kind of trust. That sort of spousal trust is going to be able to continue to access the principal residence exemption during that time.
Okay, great, thank you. One question came up just as a note of clarification.
Mhm.
When you're referring to spouse throughout this presentation, does that also refer or include common law spouse?
Yes, it does.
Okay, thank you. Hopefully that answers the question there. A couple of questions around executors and areas of residence. So this one states, I was of the understanding that executors of estates in Alberta must be residents of Alberta. Is that true?
So if I might be misinterpreting your question, so hopefully I ask what you need. And if you are living here in Alberta, you don't have to name an Alberta resident as your executor of your estate. It's more convenient. I mean, there are some benefits from doing so, and you'd want to talk to your lawyer about whether or not there's a potential that a non-resident of the province might have to pay a bond or do some extra paperwork. But from a tax filing perspective, we just need to know where the person lives, and the estate will be resident of that province.
Okay, great. So just carrying on from that, this next question right underneath it was about two executors, one living in Alberta, one in BC. Where does the tax file, the tax return, where does the executor file the taxes? Does it matter?
So we'll have a conversation with those two executors in that instance and sort of say, here's some things that would be looked at of where it is. And so if, for example, the property is here in Alberta,
Mhm.
and as much as everybody's cooperating, realistically, the person who's here in Alberta is probably doing a bit more of on the ground work. Um, we would take a position that more is happening here, and declare it as a residency of here.
Sounds good. And just one more here on executor requirements. Can you revisit the requirement of an executor that lives in the United States?
Okay, so if your executor lives in the United States, we you're going to have to talk to a lawyer about what bonding requirements and things there might be and what issues that might cause from a legal perspective, because it also potentially causes some other non-tax issues of sometimes there's issues with being able to take instructions for investments in one country or the other. And so there's a number of non-tax things to ask about and find out whether or not they're specific to your situation. But just from a pure tax perspective, if the executor is resident in the United States, the estate will also be resident in the United States and have a filing requirement in the United States.
Okay, thank you. Couple questions here around gifting
Mhm.
and the tax consequences. So I'll get into that. Um, as the power of attorney and executor, should I distribute funds from, in this case, my parents' account before death to avoid paying excessive taxes at the time of death, but while still being responsible for their current needs while they're still alive?
Okay. That's really more of a legal question than a tax question. So, um, and so just overall, sort of looking at who are we able to reach out to as the individuals who are responsible things at times. As the power of attorney, you're going to be responsible for the assets and the taxes resulting from those up to the date of death. And then as executor, you're going to be responsible for the assets and the tax filings after death. And those are for two very distinct
Mhm.
buckets that you do need to deal with. And so as a power of attorney, you do have certain responsibilities and requirements, and you'll want to talk to a legal advisor about where that boundary is. But in general, no. It's but again, obviously a legal issue versus a tax issue and get some advice, but keep in mind those are very distinct roles and buckets of responsibilities and funds.
Great. Couple more around gifts here. If I gift to family members, I'm assuming through the estate, do they need to pay taxes on that gift? Is there a maximum value of the gift that are non-taxable?
Okay. And so in Canada, you can gift to individuals during your lifetime or in your estate. And those Canadian individuals will receive those assets on a tax paid basis. So if you either gift during your lifetime or in your estate, you're gifting at fair market value, you're paying tax on that gift, or your estate is. The individual is receiving it at that value and only will pay tax on any increase in value when they sell something in the future. So if you gifted someone a lake property, the tax was paid up to 500,000, they sell it for 525, they would only be responsible for the tax on that $25,000 increase.
Great. There's a question here around charitable giving that I might help a little bit, but
Sure.
you also might be able to help here. So this is going to get a little specific, so I apologize
Mhm.
for some of the people who might be listening, but here's the question. If I create a trust through the St. Albert Community Foundation, which is an organization that is connected to Edmonton Community Foundation, are there any benefits and liabilities to start the trust while I'm alive? Are the benefits or negatives to donate artwork prior to death or upon death? So I'll just, from a charitable standpoint or
Yeah.
from this
Mhm.
philanthropic standpoint, and Michelle, maybe you can back me up a little bit on this as I make this answer here. But if you are looking at leaving a gift to St. Albert Community Foundation or ECF or any other charity, for that matter, in your lifetime, you would receive those tax benefits within your lifetime.
Mhm.
And the same would go for your estate. If it was after your lifetime, you'd receive those benefits when the gift is received by the charity. The benefit of doing potentially something like this in your lifetime, beyond the taxes, is that you get to see your money put to good use. So if there is something that you really wanted to support within our communities, working with one of our organizations or any charitable organization that you might support, gives you the opportunity to see your philanthropic dollars in action. And while certainly we deal with many donors that establish something after their lifetime, there's absolutely nothing wrong with doing so. This does give you the benefit of seeing your philanthropic dollars in action. Again, it's completely up to you, any individual donor, how you might want to proceed with supporting the community, but always something to consider for one way or the other. What I
Mhm.
would suggest is that if this was a conversation that you want to have in a little bit more detail, to reach out to anyone at St. Albert Community Foundation or here at ECF to have that discussion.
Mhm.
And I will say around the artwork, though we have received gifts of art in the past, can be very difficult to value, and can be something that organizations might shy away from if they do not have the capacity to deal with it. So, just something to keep in mind that if you are considering leaving a gift, no matter what it might be, to a charity, both in your lifetime or after, always a smart decision to have that conversation with the charity first to make sure that they can actually accept the gift. Because if you do end up leaving something behind in your will that a charity can't accept, that gift might default, which is not something that anybody wants to have a
Mhm.
conversation about. So, sorry, long-winded answer, but always nice to see when somebody's
Mhm.
actually talking about charity in some of these
Yes.
sessions.
No, that, and I agree with everything you said there. That's a couple of things just to add from a tax perspective. If you make a donation in any year during your lifetime, that you just don't need the entire donation in this year, because perhaps you've decided that your church, for example, is replacing their roof, and you would like to, rather than give your regular donation in each year, give them a lump sum so that they can seed that account or something. If we don't need that entire donation receipt in that year, then that donation receipt can be carried forward for up to 5 years. So also keep in mind that we're able to use that where it can be put to best use. I agree 100% with having that advantage of perhaps being able to see what your dollars have used. One of the best conversations I had with a client, he had decided that he was going to make a donation to his local library. His wife had passed away and he was going to do a donation in her name, because now he said he can go and sit on the bench under her name and read a book and think about her, versus leaving it in his will. And there's nothing wrong with any decision. You just have to come up with what means the most to you. With things like artwork or other assets, because we can figure out the value of cash, investments, real estate relatively easily, some of those items that it's more difficult to value are even more difficult to figure out how much you paid for them. So regardless of when you're doing that, have good records of how much you paid for these pieces or these assets and when you purchased them, because that's going to be important to determine the potential capital gain.
Yeah, perfect. Thank you. And I knew that you would come in with some additional information there, especially about carry forward, things like that. So
Mhm.
thank you for that part of the answer. I have a question here around someone who owns a company. If I have a company and I make my children shareholders of that company, is that a good tax planning strategy?
It depends. And so our first thing it depends on is whether or not your children are actually truly active in your company or put something into your company. And so the rules that CRA, or sorry, that finance put in place, the CRA needs to administer, for tax on split income, reduces some of the ability to split income with children. And so adding children as shareholders may make things a little bit easier as companies continue to evolve and they become more involved themselves. And whether that's directly or through a trust, we have some options. But as far as being able to split income during your lifetime or eliminate the deemed disposition, that's going to be very dependent on your situation, likely not as effective as you're hoping. And corporations as well, have those conversations with your advisors in advance, because without proper planning, shares of private corporations end up having double tax on them. And so we need to make sure that we're in place to be able to plan for that within your estate. And so some things need to be worded specifically in your will. Your executor needs to be aware of their timeline, and we could do a whole day just on that session alone. So reach out to your advisors in that situation.
Great, thank you. Bit more of a basic question here. Is there a checklist that can be provided or can be accessed that can be provided to someone's executor?
Okay, and I believe all financial institutions have a great executor checklist. I would hazard a guess that your organization may as well. I do also have one. So, and there are, if you're working with a financial institution already, they would certainly have one available for you. And you've got my contact information there. If you can't find one, you can send me an email. I can send you the one we have. I mean, ultimately, it does its best to come up with a list of everything that we can think of. But there's always going to be a little bit more. And there are great books and binders and things available through Chapters, Amazon, wherever, also sort of called death binders or life binders, if you don't want to be creepy about it, of just sort of what information to gather up. So maybe take a peek at some of those resources as well.
Yeah, and so I left your contact info up there for quite some time, so hopefully people were able to see that before I stopped the sharing of the screen there. But I will let people know that Michelle was really nice and provided us with a PDF of her slide deck that we will be sharing with the registrants of this session, which of course will include not only all of the information that Michelle has covered today, but her contact information as well. So something to potentially look into if you need a little bit of advice. But on that note, and this is probably an answer that I would likely think is going to be, it depends.
Mhm.
But how much do tax advisors like you usually charge for tax planning?
Okay, and so this is where it's going to be very important for you to be a knowledgeable consumer for all of your factors. So your lawyer, perhaps a trust company, your accountant, you should upfront ask them how they are billing. So a lot of financial advisors, rather than charging, or sorry, tax advisors will charge rather than basing a flat fee. So it's not going to be a percentage of the size of your estate. It's typically going to be an hourly fee. And so we would sit down with you, get an idea of what projects we think are needed to be done, what filings are going to need to be done, and give you a range of what we expect that will cost based on how long it typically takes us to do it, whether or not we think there's going to be a CRA review, and sort of give you a range at the time. But again, just have those conversations of picking a fee structure that you're comfortable with, and making sure that any contracts you sign also, or engagement letters you sign, outline that agreement of how that individual is going to be paid.
Great, thank you. And just around tax advisors, one more question here. Are there tax advisors who can handle assets overseas, not just simply domestic or US securities or assets?
Absolutely. I mean, there are the larger accounting firms are perhaps going to have international tax teams within them. And most big law firms or bigger accounting firms as well are going to have connections with networks through their professional organization as well. Like MNP, for example, we have an affiliation with an association called Praxity, which allows us to reach out. But also professional designations have those connections as well. And so you have that talk about what the situation may be for you, and the advisor that you're sort of interviewing to see if they're the right connection for you, what services can they offer or connections can they make for you.
You've been really generous with your time in answering some questions here, so I don't want to just bombard with everything, but maybe just a couple more to wrap up,
Absolutely.
if that's
Mhm.
okay. One here about life insurance. If is life insurance payable to the estate taxable income on the estate return?
No, it is not.
Thank you.
Um, Now, I'm just going to add one thing to that because we were mentioning earlier about it being important that graduated rate estate status maintains itself. So if we have insurances being paid to the estate, we have no issue. Sometimes people have life insurance paid to a spouse or whoever their executor is going to be with the intention it's going to be used for tax.
Mm,
Make sure you ask those questions early about when tax can be paid using that money, but it is going to be tax-free money to whoever's receiving it.
great. Thanks. And then maybe just a couple last questions
Sure.
here around CRA clearance. There's a couple of clearance certificate questions.
Okay.
If your estate taxes are paid, how do you obtain a clearance certificate from CRA?
And so there's a form available online, and it's called a TX19. I think it's just called Request a Clearance Certificate. It's a very simple title, but TX19 is what you're going to search for. That document's available online, and you'll fill out what you want the clearance for and what dates you want it for. And the information document that's along with that, attached directly to the form, is going to outline what things that they are requesting that you provide as support for that certificate. It takes about 120 days to get it from the CRA right now.
Great, thank you. And this was, I think, from the presentation. This was asked a little bit earlier, but is there or are there any examples you can provide of when you do not need a, CRA clearance certificate?
Um, so if you were the only executor and the only beneficiary of the estate, you already have all of the assets that are earning income that perhaps CRA could reassess something on in the future. And so in instances where you're the only person, you're not going to go after yourself to get money back.
Mhm.
So in that situation. But that being said, there's a value in having that piece of paper that says you're done, that does give just an overall comfort and feeling of completeness that has value even beyond that potential protection. Whenever there's more than one person involved, I recommend we get the clearance certificate because no matter how much you like your brother, you give him the money and he spent it and you want some back. He could have spent it on the most responsible thing ever, but he just doesn't have it to give it back to you. And so, protect yourself, make sure that you're covered off before you do that final distribution. You can work
Awesome.
with your advisors to potentially do a partial distribution and hold back an amount, and that's going to be very case specific on what a reasonable amount would be.
Sure. Okay, thank you. I know that there are still some questions in here, but
Mhm.
you've been super generous with your time. And so I'm going to thank everybody for not only participating in asking questions, but being such an attentive audience. It was great to see such a great turnout today. I will let people know that there still are a few more Wills Week sessions taking place over the next 24 hours or so, including a charity specific session. So if there are folks that want to learn a little bit more about the philanthropic conversation when it comes to your potential estate planning, my colleagues, Noel Xavier and Sydney Stewart, will be hosting a session coming up today at 1 o'clock. So just in a couple of hours. That will walk through, doesn't have to just simply be ECF specific, but charity specific as well. And since we're talking about tax today, might be something that dovetails nicely into this conversation. So keep those sessions in mind. But just wanted to remind everybody once more that when you close out of this, there will be a short survey that I ask that you please take a couple of minutes to fill out to make sure that we're providing worthwhile information through these Wills Week sessions. And one final reminder that the recording for this session and any other virtual session should be up on our website and YouTube pages within the next week. So do check back, and we will provide the slides from this session to everybody who's registered in the next day or so as well. So thank you again. Michelle, really appreciate your time and expertise. Any closing thoughts for the group before we say goodbye?
just to sort of reiterate that it is very important to have communication, both with your family, so they, or your family and your intended beneficiary, so they know what's happening, and having that back and forth, because perhaps what you think they would like is not what they would like, and so on, and things you think might happen maybe aren't going to. So have those discussions with family, have those discussions with your advisors early, and give your advisors permission to talk to each other so that we can put a holistic plan together that just really works well and helps you hit your goals. And make sure you ask the right people the right questions. So legal questions, reach out to your lawyers and so on, and making sure that you make the best decisions for you.
Awesome. Thank you. Great advice. Thank you again for your time today. Thanks to all of you for tuning in. And I hope that everybody has a very good Thanksgiving weekend coming up this weekend. So take care, everybody. Thank you very much. And hopefully we'll see you at some of the closing Wills Week sessions here over the next day or so. So take care. Thanks, everyone.
Thank you.